Have you ever wondered what it takes for a pharmaceutical giant to not just survive, but to truly reinvent itself and thrive after facing down what looked like, well, an existential threat?
It's a fascinating question, isn't it?
We're talking about a company that navigated a really treacherous patent cliff and somehow emerged stronger, more innovative, and frankly, with an audacious vision for the future.
Yeah, a real turnaround.
Today, we're embarking on a deep dive into AstraZeneca PLC, ticker AZN.LSE.
AZN, right?
Our mission here is to unpack a comprehensive investment analysis, revealing the strategic bedrock of its industry-leading growth, its ambitious future strategies, and importantly, the significant risks it's meticulously working to navigate.
And there are definitely risks.
We're going beyond the headlines to give you the most important nuggets of knowledge about this global biopharmaceutical powerhouse, and it's really remarkable turnaround story.
That's right. And this isn't just about one company's P&L. It's a deep dive into how scientific leadership, strategic foresight, and disciplined execution can fundamentally reshape a global enterprise, especially within the high-stakes world of medicine.
Okay.
This deep dive draws from an in-depth equity investment analysis, offering a detailed perspective on AstraZeneca's current standing and, its future potential. We'll be looking at the hard data, the strategic plays, the big picture trends that define its journey, all through the lens of their, frankly, compelling comeback.
Okay, let's unpack this then. To truly understand AstraZeneca's remarkable journey, we really need to set the stage first. We need to understand the broader global pharmaceutical landscape it operates within.
Absolutely essential context.
It's a sector brimming with incredible growth opportunities, yes, but it's also facing some formidable and rapidly evolving challenges. What stands out to you first, just in terms of the sheer scale and trajectory of this market?
What's truly striking here is the sheer scale, first off, and then the relentless, almost, inevitable growth trajectory. The global pharmaceutical market, already valued at a staggering $1.67 trillion in 2024.
Wow. Trillion.
Yeah, trillion with a T. It isn't just holding steady. It's projected to surge to an impressive $3.03 trillion by 2034.
That's almost double.
Pretty much.
Oh.
That reflects a robust compound annual growth rate, or CAGR, of 6.15%. So we're talking about consistent mid-single-digit expansion over the next decade. This isn't just an upward trend. It's a fundamental societal demand that just keeps expanding.
Right.
And while North America still reigns supreme with about a 42% market share, we're seeing significant geographic shifts. Asia-Pacific is now the fastest-growing market.
Interesting.
Yeah, with China alone expected to exceed $230 billion by 2025. So this isn't just a bigger pie. It's a global rebalancing of where that growth is actually coming from.
Okay, that's absolutely massive. But beyond just more people needing medicine, what are the underlying sort of deeper trends driving this kind of sustained growth? It can't just be a simple population increase, can it?
No, you're absolutely right. It's not just simple demographics, although that plays a part. The growth is deeply embedded in several fundamental secular trends that are reshaping healthcare worldwide.
Okay, like what?
Well, first, we're witnessing the escalating healthcare demands of aging populations globally, especially in developed nations where the geriatric segment is expanding rapidly, often with multiple chronic conditions.
Makes sense.
Then there's the rising global prevalence of chronic diseases, conditions like cancer, diabetes, cardiovascular issues, which unfortunately continue to be major health burdens requiring long-term treatment.
Right, these aren't going away.
No, sadly not. And crucially, expanding healthcare access and improving infrastructure in emerging economies are bringing millions more people into the healthcare system. That significantly increases demand for advanced medicines. These are powerful, undeniable forces driving the market forward.
So it's a powerful combination: demographic shifts, a growing burden of chronic illness, and a global expansion of access. That's quite a tailwind. But let's talk about the really cutting-edge stuff. How are revolutionary technologies like, say, artificial intelligence and entirely new types of medicine changing the game for a company like AstraZeneca?
Yeah, this is where the story truly becomes dynamic, I think. AI and machine learning, for instance, they're no longer just futuristic concepts. They're becoming integral to drug discovery and development right now.
Really? How integral?
Well, projections indicate that AI will drive an astounding 30% of new drug discoveries by 2025.
30%? That's huge.
It is. And this isn't just about buzzwords. For a company like AstraZeneca, which has really staked its claim on science-led innovation, it's a strategic weapon. AI's ability to analyze massive data sets is expected to slash preclinical discovery timelines and costs by maybe 25–50%.
Wow, that's a massive efficiency gain.
Exactly. Imagine the impact on R&D budgets, yes, but maybe more importantly, the speed to market. For AstraZeneca, with its massive oncology pipeline, this means they can potentially bring life-saving drugs to patients years faster than before. That gives them a critical lead in fiercely competitive areas like antibody-drug conjugates, where speed and precision can mean billions in revenue and, countless lives saved.
So it changes the economics and the timeline.
Fundamentally, it shifts the risk profile of their huge pipeline, allowing them to take bigger, bolder scientific bets, knowing they can iterate faster and, frankly, fail cheaper if needed.
That's a profound shift, enabling both speed and efficiency. So AI is streamlining the foundational work.
Huh.
But what about the actual types of drugs being developed? We hear a lot about biologics and personalized medicine. What does that mean for how diseases are actually treated?
Indeed. While traditional small molecule drugs still dominate, representing about 57% of the market in 2024, biologics and biosimilars are the fastest growing segment.
Okay, what exactly are biologics?
They're complex medicines derived from living organisms. Think sophisticated therapies like monoclonal antibodies, cell therapies, gene therapies. These often target specific disease pathways with incredible precision, much more targeted than older drugs.
Right, more like a guided missile.
Exactly. And this trend goes hand in hand with personalized medicine, which aims to customize treatments based on an individual's unique genetic makeup or biomarker profiles. The idea is to match the right patient with the right drug at the right time, minimizing side effects and maximizing efficacy.
The holy grail, really.
Pretty much. Investment in precision medicine is forecast to surpass $80 billion by 2025. That represents a huge opportunity for companies like AstraZeneca with strong targeted therapy pipelines, especially in oncology. And speaking of new drug classes creating huge waves, you simply cannot ignore the GLP-1 disruption.
Ah, yes, the GLP-1s. For diabetes and obesity. Those have been absolutely everywhere in the news lately. What does that particular phenomenon tell us about the industry's potential for truly radical disruption, even in, well-established markets?
The explosive growth of GLP-1 receptor agonists is really a textbook example of how quickly a truly innovative new drug class can emerge and fundamentally disrupt established markets. These drugs haven't just created significant new value pools, potentially in the hundreds of billions.
Hundreds of billions.
Potentially, yes. They've also completely reshaped treatment paradigms for diabetes and obesity and are even impacting related sectors like medical devices and even the food industry. It shows that even in a mature industry, truly innovative therapies can rapidly achieve blockbuster status and redefine entire categories. They shift the goalposts for every other player.
It's a reminder that breakthroughs can come from anywhere.
Absolutely. And that leads to another fascinating shift, how clinical trials themselves are being conducted. We're seeing more decentralized trials using digital tech, remote monitoring.
So patients don't always have to go to a clinic.
Exactly. And regulatory agencies are increasingly accepting what's called real-world evidence, or RWE, gathered from electronic health records, wearables, things like that. This demands sophisticated new digital health capabilities from pharma companies. It's evolving how they gather data and ultimately bring drugs to market.
So, okay, we have incredible growth potential, revolutionary innovation, even how clinical research is done. It's all transforming. But as the saying goes, no good deed goes unpunished. All this innovation and growth must surely come with some formidable headwinds, right? Where are those pressures truly being felt by companies like AstraZeneca?
You're absolutely right. While the opportunities are immense, there's a powerful counterforce at play. And at the top of that list, no question, is the intensifying drug pricing pressure, particularly here in the U.S.
Ah, yes, the big one.
The U.S. Inflation Reduction Act, or IRA, of 2022 represents a structural shift, not just a cyclical downturn in pricing power. It empowers Medicare to directly negotiate prices for some of the highest-selling drugs, which fundamentally weakens the traditional pricing power that has long underpinned pharmaceutical profitability.
That sounds like a fundamental change to the business model.
It really is. It's a game changer for how companies strategize product launches and manage their portfolios long-term.
That sounds like a seismic shift, especially given the U.S. is, as you said, the largest market. Are there other ways that traditional pricing power is being eroded beyond direct negotiation?
Absolutely. Beyond direct price controls, manufacturers are experiencing what's called gross-to-net erosion.
Gross to net. Okay, what's that?
It's basically a growing chasm between a drug's list price, the sticker price, if you will, and the net revenue the company actually receives. This gap widens due to escalating rebates, discounts, and chargebacks demanded by pharmacy benefit managers or PBMs and other payers.
So more middlemen taking a cut.
Essentially, yes. It's a continuous squeeze on profitability margins that compounds the direct pricing pressures from things like the IRA. And then, of course, there's the perennial patent cliff.
Right, the that's a cyclical reality in pharma, isn't it?
Hmm.
Where products lose their exclusivity, generics rush in, and revenues can just plummet.
Precisely. It's arguably the most defining and frankly terrifying feature of the industry's business model. Nearly 50 products are expected to lose patent protection between 2023 and 2025 alone.
50, wow.
Yeah, putting billions of dollars in revenue at risk across the entire sector. This creates immense pressure for companies like AstraZeneca to constantly innovate and replenish their pipelines with new blockbusters, because as soon as that exclusivity ends, sales can fall off a cliff, sometimes literally overnight.
A constant race.
A constant race. And on top of that, you have persistent regulatory and operational hurdles, navigating complex global regulations, ongoing talent shortages in specialized scientific and digital roles, vulnerabilities in global supply chains.
Which the pandemic really highlighted.
Painfully so. And let's not forget the incredibly high cost and long duration of clinical trials themselves, which remain a formidable barrier to entry and a constant drain on resources.
Okay, so it's a complex picture. How are companies like AstraZeneca actually responding to this environment, these incredible opportunities on one side and these formidable challenges on the other? It sounds like they need a very, very nuanced strategy.
You're spot on. The convergence of these trends truly mandates a sophisticated strategic response. One thing we're seeing is what some call a barbell approach to R&D.
A barbell. Okay, explain that.
Well, on one end of the barbell, companies are leveraging technology like AI to de-risk and accelerate the development of more conventional assets. Think faster screening, better clinical trial design, getting known quantities through quicker.
Right. The safer bets.
Exactly. This frees up capital that can then be deployed to the other end of the barbell. The high-risk, high-reward breakthrough platforms, things like next-generation biologics, cell therapies, gene therapies, the really cutting-edge stuff.
So using efficiency gains to fund the moonshots.
That's a good way to put it. This balancing act, pursuing efficiency in established areas to fund revolutionary science in nascent fields, is absolutely key to long-term success and, crucially, for navigating those patent cliffs we just talked about.
That's a great analogy, the barbell approach. It makes perfect sense to de-risk some areas to fund the bigger, potentially more transformative bets. And what about those supply chain vulnerabilities you mentioned earlier? How is that changing strategy, especially in an increasingly, shall we say, fractured geopolitical world?
Yeah, that's a critical point. The industry's historical reliance on globalized supply chains, especially for active pharmaceutical ingredients or APIs, often sourced from places like China and India, is undergoing a serious reevaluation.
Understandably so.
Amid rising geopolitical tensions and the harsh lesson that global crises are a recurring feature, supply chain management has fundamentally shifted. It's moved from being primarily a cost optimization function to being a critical component of enterprise risk management.
So resilience over pure cost savings.
Precisely. This is driving a strategic shift towards right-shoring, bringing production closer to e-commerce, and building more resilient, often localized manufacturing capabilities. It definitely means higher capital expenditures in the near term.
More expensive upfront.
Yes, but it's seen as essential for ensuring long-term operational stability and mitigating those geopolitical risks. It's a fundamental recalibration, recognizing that resilience is now paramount, maybe even more than cost.
That's a comprehensive and insightful overview of the pharma landscape. Really sets the scene. Now that we understand this dynamic environment, let's zoom in on AstraZeneca itself. How does it actually stand out within this intense competitive field? What's its market position and who are its main rivals?
What's truly notable here is AstraZeneca's consistent position in the upper echelons of the industry. It consistently ranks among the world's top 10 pharmaceutical companies by revenue.
Top 10, okay.
In fact, one industry ranking placed it fifth globally in 2024, with pharmaceutical sales hitting an impressive $54.1 billion.
$54 billion, that's significant.
Very. And with a market capitalization hovering around $251 billion, it's firmly established as a large cap leader, a titan in its own right. Its primary competitors are, as you'd expect, the other research-driven multinational corporations: Pfizer, Merck, Novartis, Roche, J&J, AbbVie, BMS, GSK.
The usual suspects.
The usual suspects, exactly. These are the giants it competes with fiercely for everything from R&D talent and pipeline assets to market share, all striving to define the next generation of medicine.
That's a strong competitive set indeed. Where does AstraZeneca really shine in terms of its therapeutic areas? Is there a particular powerhouse segment driving their success?
Oncology. Unequivocally, oncology is AstraZeneca's powerhouse. It's the cornerstone of their growth, and really a testament to their focused scientific strategy over the past decade.
Okay,
It accounted for approximately 43% of the company's total revenue in the first half of 2025.
almost half their business.
Almost half. And it's growing at a robust 18% at constant exchange rates. This leadership isn't accidental. It's built on a portfolio of highly successful, often first-in-class medicines that are redefining standards of care in cancer treatment.
Can you give some examples?
Sure. Think of Tagrisso, a leader for a specific type of non-small cell lung cancer. Imfinzi, an immunotherapy drug, a PD-L1 inhibitor approved across multiple cancer types. Lynparza, a first-in-class PARP inhibitor, which they co-commercialize with Merck. And Calquence for certain types of blood cancers. This deep specialization in oncology has allowed them to build a truly formidable presence.
And I've heard a lot about antibody-drug conjugates, or ADCs, recently.
Yeah.
They're often heralded as a revolutionary new class of cancer therapy.
Yeah.
How does AstraZeneca play into that cutting-edge area? Is that part of their oncology strength?
Oh, absolutely. This is where AstraZeneca has made a truly strategic and frankly very impactful bet. Enhertu, which they partnered on with Daiichi Sankyo, is a revolutionary antibody-drug conjugate.
Okay, break that down. What is an ADC exactly?
Think of ADCs as guided missiles for cancer treatment. They combine a powerful chemotherapy agent with a monoclonal antibody that specifically targets cancer cells.
So it delivers the payload right to the tumor.
Precisely. It delivers the drug directly and minimizes harm to healthy tissue. Enhertu is transforming the treatment of HER2 positive and also HER2 low breast cancer, among other solid tumors. It's really moving the needle for patients in those areas. This innovative modality is a significant competitive advantage for them right now.
And the competition sees that too, right?
Oh, definitely. The competitive landscape in oncology is fierce, with established leaders like Merck's Keytruda, BMS's Opdivo, and Roche having huge presences. The fact that Pfizer significantly bolstered its own oncology presence by acquiring the ADC specialist Seagen,
Right, that was a big deal.
a huge deal. It further highlights the strategic importance of this modality, this ADC technology, where AstraZeneca, with Enhertu, already hold a very strong and pioneering position. They were early and smart there.
So they've carved out a very strong niche, almost a dominance in oncology with these advanced therapies. But what about their core competitive advantages, the true sort of economic moats that protect their business and ensure long-term sustainability? What keeps rivals at bay?
AstraZeneca benefits from several durable competitive advantages, which are absolutely critical for weathering industry storms like patent cliffs and pricing pressures. First, a robust patent portfolio.
The legal shield.
Exactly. Intellectual property is the lifeblood of pharma, protecting those key revenue-generating products. For instance, patents for pivotal drugs like Calquence and Breztri extend well into the 2030s. That offers long-term revenue visibility and protection against generic competition for years.
Okay, patents are key. What else?
Second, and I'd argue critically, a world-class R&D engine. This is probably their most important long-term advantage. Their proven ability to consistently discover and develop new medicines, often pioneering new therapeutic modalities like those ADCs.
Their innovation machine.
Precisely. With 196 projects in development currently, AstraZeneca has one of the industry's most productive pipelines. It showcases high scientific and clinical development expertise. This R&D engine is really the heart of their comeback story, rebuilding their growth after those earlier patent expirations threatened the company.
So it's not just the drugs they currently have on the market, but their inherent capability to keep creating new ones. That makes sense. What about working with others? Do they tend to go it alone, or do they actively seek collaborations and partnerships?
They absolutely leverage strategic partnerships, and this is a significant strength, I think. The collaboration with Daiichi Sankyo on Enhertu and now Daiichi is a prime example. It combines Daiichi Sankyo's cutting-edge ADC technology with AstraZeneca's deep clinical development and global commercialization expertise.
A win-win.
A true win-win, creating a dominant force in this revolutionary field. Similarly, the profit-sharing agreement they have with Merck for Lynparza has been instrumental in maximizing its global commercial reach, allowing both companies to benefit significantly.
So partnerships expand their reach and capabilities.
Definitely. These partnerships don't just augment their internal capabilities. They provide crucial access to external innovation. They help share the immense risk and cost of drug development, and they rapidly expand market penetration in ways that would be much slower, or maybe impossible, alone. And of course, underpinning all this is their deeply entrenched global commercial infrastructure. Operating in over 100 countries ensures their innovative medicines reach patients worldwide, maximizing their commercial potential in very diverse markets.
Okay, it sounds like they have a very strong foundation built on internal innovation, smart partnerships, and global reach. What about pricing power and brand strength? Do they still have the ability to command premium prices, especially given those industry headwinds we discussed earlier, like the IRA?
What's fascinating here is the duality of their position. The innovative nature of AstraZeneca's portfolio, especially its first-in-class oncology medicines, has historically granted them significant pricing power at launch. Drugs like Tagrisso and Enhertu, which really redefine standards of care and offer substantial clinical benefits, naturally command premium prices reflecting their immense value.
Because they work well and fill a need.
Exactly. However, that pricing power is undeniably eroding due to those systemic industry pressures we talked about, most notably the Inflation Reduction Act in the U.S. and similar pressures globally. That's a reality.
But their brand must count for something.
It does. Their brand strength and established efficacy among specialists, particularly oncologists, foster a strong reputation and physician loyalty. This creates a powerful barrier to entry for competitors. Doctors trust AstraZeneca drugs because they have a proven track record of clinical impact, and that trust is hard-earned and valuable.
So a strong brand provides some resilience, even as those pricing pressures intensify. How is AstraZeneca evolving its overall strategy to stay ahead? You mentioned a platform-based innovation approach earlier. And what's this about a China paradox? That sounds intriguing.
Yeah, AstraZeneca is truly moving beyond just relying on single blockbuster drugs.
Right.
They're trying to build leadership in entire therapeutic platforms and technologies. They're working ADCs with Daiichi Sankyo or in DNA damage response inhibitors like Lynparza are prime examples.
This is mastering a whole area of science.
Pretty much. This isn't just about launching one drug. It's about building a sustainable knowledge moat around a whole category of therapies. It creates what you might call a pipeline within a pipeline, generating a continuous stream of next-generation assets from that core expertise. This strategy sustains innovation more durably than just hunting for isolated hits.
That sounds much more sustainable long-term.
Okay.
And the China paradox.
Right. China is a complex and highly strategic asset for AstraZeneca. On the one hand, it has been a powerful growth engine for them for years, and they're investing heavily there, including a new $2.5 billion R&D center in Beijing.
Wow, big investment.
Huge. But this strong position also creates a concentrated source of risk. You have government volume-based procurement, or VBP, policies that aggressively push down drug prices for older products. And then there are ongoing investigations by Chinese authorities, which create significant geopolitical uncertainty and potential disruption.
That's massive opportunity, but also significant risk.
Exactly. It requires a very careful and delicate weighing of that immense market opportunity against substantial political and regulatory disruption risk. It's a tightrope walk.
That's a fascinating strategic evolution and a very clear illustration of balancing high-growth opportunities with significant geopolitical risks. Okay, now that we've seen how they stand out, let's really deconstruct the business model itself. How do their revenue engines actually break down across different therapeutic areas and geographies? And critically, what does their patent expiration timeline look like? Because that patent cliff sounds like a constant looming threat.
You got it. AstraZeneca's core business model, at its heart, revolves around the discovery, development, and commercialization of innovative, patent-protected prescription medicines. Pretty standard for big pharma. Its revenue streams are diversified, but, as we discussed, there's a significant concentration in oncology, and it's balanced across established and high-growth markets. Let's break down where that revenue is coming from, maybe using the first half of 2025 data to give a clearer picture.
Great, let's get into the numbers. Where's the money coming from?
Okay. So oncology, as we highlighted, is unequivocally the primary growth engine. It represents 43% of total revenue.
Still almost half.
Still almost half, bringing in nearly $12 billion, 11.97 BN, with impressive 18% growth at constant exchange rates. This segment is robustly driven by those blockbusters, Tagrisso, Imfinzi, Lynparza, Calquence, and the really rapid uptake of their revolutionary ADCs, Enhertu and Datroway.
Okay, oncology leads. What's next biggest?
Next is CVRM, that's cardiovascular, renal, and metabolism. This accounts for 23% of revenue, about $6.5 billion, and it's growing at a healthy 8%. This is largely driven by their huge blockbuster SGLT2 inhibitor, Farxiga.
Farxiga. We'll come back to that one, I'm sure. What's an SGLT2 inhibitor do?
Right. It works by helping the kidneys remove sugar from the body through urine. It's highly effective not just for diabetes, but also proving beneficial in heart failure and chronic kidney disease, which has really broadened its use.
Okay, got it. So oncology and CVRM are the big two. What about other therapeutic areas?
Then we have respiratory and immunology, or R&I, that contributes 15% of revenue, around $4.18 billion, growing about 3%. This segment is led by established products like Symbicort, but also includes newer biologics like Fasenra, Tezspire, and Safnello.
Okay, solid contributor.
Then established through that huge $39 billion election acquisition back in 2021, rare disease now contributes 12% of revenue, about $3.5 billion, 3.51 B-pence, growing 5%. Key products here are Ultomiris and Soliris. Ultomiris is driving the growth as patients transition from the older Soliris, which is part of their life cycle management strategy.
Makes sense. And the last bit.
Finally, vaccines and immune therapies, or V&I. It's a smaller segment, just 1% of revenue, around $280 million, and it's actually declining by 19%. This is primarily driven now by the RSV antibody Beyfortus, as the revenue from their COVID-19 vaccine has become pretty much immaterial.
Okay, so a diverse portfolio overall, but with oncology clearly leading the charge and CVRM is a strong second. And geographically, where are they generating most of their money? What does that tell us about their market focus and perhaps their risks?
Geographically, the United States remains their largest single market. It accounts for a significant 43% of revenue, again, nearly $12 billion, 11.97 BNAT. And crucially, it's driving the majority of their growth with a strong 12% increase. This really underscores the importance of the U.S. market for their profitability.
Can't overstate the importance of the U.S.
Absolutely not. Europe is a mature but consistently growing market, contributing 21%, or about $5.8 billion, 5.84 billion, with solid 8% growth. Then there's China. Despite the headwinds we mentioned, it still contributes 13% of revenue, about $3.7 billion, 3.74 billions. But it is facing challenges from generic competition for older products like Pulmicort and those government VBP pricing policies, leading to a 5% decline recently.
There's that paradox again.
Yeah.
Still huge, but shrinking slightly and risky.
Exactly. And finally, emerging markets, excluding China, represent 15% of revenue, about $4.18 billion, or 0.18 BNs. This is a diverse region, but it's growing at a robust 12%, making it a key engine for future volume growth and important diversification away from the pressures in established markets like the U.S. and China.
Okay, so U.S.-centric for profitability and growth driver, strong European and emerging market presence, but China is clearly a watch point, both for opportunity and risk. Now let's talk about that crucial patent cliff again. This truly defines the sustainability of a pharma company's revenue, doesn't it? It's a constant race against time.
You've hit on the absolute core tension of the pharmaceutical business model. The drug life cycle and the patent expiration timeline is a critical risk factor for AstraZeneca, and indeed for any innovative pharma company. The sustainability of their revenue is intrinsically linked to patent protection. And what's most significant here right now is the imminent patent cliff they face. It's going to be a true test of their pipeline and their commercial capabilities in the next few years.
Okay, lay it out for us. Which drugs are facing the drop?
The biggest one, by far, is Farxiga, their major CVRM revenue driver, bringing in $7.7 billion in 2024 sales. It's facing imminent loss exclusivity in 2025 in both the U.S. and the EU.
$7.7 billion at risk in 2025. That's huge.
It's a massive number. The single event poses the most significant near-term challenge for AstraZeneca. It's a huge hole they need to start filling, and fast.
Okay, that's the big one. What else is on that list of high-value drugs nearing the end of their exclusivity period?
Next up is Soliris, a rare disease drug acquired with Election. It had $2.6 billion in 2024 sales and is also facing biosimilar competitions starting in 2025. Now, revenues from Soliris are expected to decline anyway as patients transition to Ultomiris, its newer, longer-acting counterpart that's a key part of AstraZeneca's mitigation strategy, switching patients before the cliff hits hard.
Okay, so some mitigation there. Any others?
Yes, Lynparza, a foundational PRP inhibitor in oncology with $3.7 billion in 2024 sales. It's set to lose exclusivity a bit further out in 2027 in the U.S. and 2028 in the EU.
Remind us what a PRP inhibitor does.
Sure. It works by blocking enzymes that help repair damaged DNA in cancer cells. Essentially, it prevents cancer cells from fixing themselves after damage, leading to cell death. It's been a very important class of drugs. So these three products alone, Farxiga, Soliris, and Lynparza, represent a substantial portion of current sales that are at risk of significant erosion in the coming years.
Okay, so Farxiga is immediate, Soliris is immediate but somewhat managed, and Lynparza is a couple of years out. It sounds like a formidable challenge. What products have longer runways that provide some stability and allow them breathing room?
Thankfully, they do have a stable foundation from products with longer patent lives. Big ones like Tagrisso in oncology, which expires around 2031 or 2032. Imfinzi, also oncology, expiring around 2028. Ultomiris, the Soliris successor in rare disease, has patents extending out to 2029 or even 2035 in some regions. Calquence, the blood cancer drug, expires around 2032. And the rapidly growing ADC in HER2 has exclusivity until 2031-032.
Okay, so there is a base of longer-term revenue.
Yes, these provide a long tail of revenue and a foundation to build on. However, the strategic imperative remains crystal clear. The successful launch and rapid scaling of new blockbuster drugs between now and, say, 2028 is not just an opportunity for growth, it's an absolute necessity. These new launches must be flawless commercially to offset the significant revenue erosion expected from those key patent expirations, particularly Farxiga. This highlights the critical, almost existential role of their pipeline execution in the next few years.
That's a very clear challenge they're facing, a high-stakes race to innovate and execute commercially. You mentioned partnerships earlier, especially the one with Daiichi Sankyo. How do those licensing and collaboration agreements contribute to their business model, especially with this patent cliff looming? Are they central to filling that potential revenue gap?
Oh, they are absolutely central. What's fascinating here is how effectively AstraZeneca leverages external innovation through the strategic partnerships. Alliance revenue, which often involves profit sharing from co-commercialized products, grew by a significant 38% in the first half of 2025.
38% growth. That's substantial.
It is. It shows its increasing importance as both a revenue stream and a strategic tool. The partnership with Daiichi Sankyo for the antibody-drug conjugates in HER2 and Datroway is a cornerstone of this strategy. It combines their cutting-edge ADC technology with AstraZeneca's deep clinical development and global commercialization expertise to create really a dominant force in this revolutionary field.
So it brings in tech they didn't develop internally.
Exactly. Similarly, the global alliance with Merck for Lynparza has been instrumental in its market leadership, providing global reach and sharing development costs. Even their non-commercial partnership with the University of Oxford for the Vaxzevria vaccine during the COVID-19 pandemic demonstrated their ability to mobilize large-scale public-private efforts effectively. These alliances allow them to share risks, access cutting-edge technologies they might not have in-house, and expand their commercial footprint far beyond what they could likely achieve alone. They directly contribute to their ability to navigate the patent cliff and fuel future growth. They're not just nice-to-haves, they're integral.
Okay, that paints a picture of a company facing a critical juncture with these patent expirations, but also actively building its future through internal innovation and these powerful strategic partnerships. Let's move on now to their financial health and future growth trajectory. This company has quite a dramatic turnaround story, doesn't it? I mean, it wasn't always this picture of robust growth.
Absolutely. It's a dramatic comeback story, one that truly defines the company today under Pascal Soriot's leadership. AstraZeneca's financial performance over the last decade is a testament to bold leadership and that relentless focus on science we talked about. After facing a significant patent cliff back in the mid-2010s that left its revenue stagnant, even declining.
A tough period.
A very tough period. CEO Pascal Soriot orchestrated a science-focused strategy that has delivered industry-leading growth and restored financial strength. Let's look at the numbers. In 2020, revenue hit $26.6 billion, marking a strong return to growth. Then, a significant jump in 2021, up 41% to $37.4 billion, driven largely by the transformative election acquisition and initial COVID-19 vaccine sales.
Okay, election was huge.
Massive growth continued in 2022, rising another 18.5% to $44.4 billion. Now, 2023 saw a more modest 3.3% increase on the surface to $45.8 billion. But that number masked a much stronger underlying performance. Revenue excluding the fading COVID-19 products grew by a robust 15%.
So the core business was still flying.
Exactly. And this momentum accelerated again in 2024, climbing 18% to $54.1 billion. For the trailing 12 months ending June 30, 2025, revenue was $56.5 billion, a 15% year-over-year increase. This clearly demonstrates durable fundamental growth, not just a one-off recovery.
That's a truly impressive growth trajectory, especially considering where they were maybe a decade ago. What about their profitability and margins, though? Are they translating that strong top-line revenue growth into healthy, sustainable profits?
Yes, they are, and this is crucial for funding that R&D engine. They maintain strong gross margins, which is typical for an innovative pharma firm that invests heavily in R&D. The trailing 12-month gross margin is a robust 82.26%.
82%, very high.
Very high. And for the first half of 2025, the core gross margin was 83%. However, management has guided for a slight contraction, maybe 60-70 basis points for the full year 2025. That primarily reflects those pricing pressures from the U.S. Medicare Part D redesign and the onset of biosimilar competition for Soliris. So
Yeah.
some pressure there.
Okay, some pressure on gross margin. What about operating margin?
On the operating margin front, they're showing positive operating leverage. What that means is their revenue is growing faster than their operating expenses.
Which is what you want to see.
Exactly. In H1 2025, total operating expenses grew by 9%, which is significantly below the 11% revenue growth. That led to a healthy 13% increase in core operating profit. Net margin stands at around 13%, 13.01%, and core earnings per share, or EPS, grew a strong 17% in H1 2025 to $4.66. They've guided for low double-digit core EPS growth for the full year 2025, signaling continued profitability improvements.
So strong revenue, healthy margins overall, and good EPS growth. That kind of performance absolutely requires consistent cash flow to fund that ambitious R&D and other strategic investments like M&A. How are they doing on the cash flow front?
Strong and consistent cash flow generation is really a hallmark of AstraZeneca now, and it's absolutely vital for funding their aggressive R&D, strategic M&A, and those shareholder dividends. They generated $10.3 billion in operating cash flow back in 2023, which is a 5% increase over the prior year. And in the most recent quarter, they recorded a positive net change in cash of $1.8 billion, 1.825 BMP. This robust cash flow provides the necessary fuel to sustain their high levels of R&D investment and pursue those strategic acquisitions, which are key to their future growth story.
Okay, cash flow looks solid. And on the balance sheet side, are they taking on too much debt to fuel this ambitious growth? Or is it generally well managed? We mentioned the big election deal earlier.
That's a fair question. They maintain a strong balance sheet overall and are committed to preserving their investment-grade credit rating. They hold A1 from Moody's and A+ from S&P, which are strong ratings. They do strategically utilize debt to fund significant initiatives like that transformative $39 billion election acquisition. Their debt-to-equity ratio was recently around 73.5%.
Okay, 73%. How does that stack up?
Well, while that's not insignificant, it's managed within the context of their strong cash generation and is considered sustainable by the credit rating agencies. It allows them financial flexibility to pursue opportunities without taking on, undue risk. Seems well managed for a company making big strategic moves.
That's a solid financial picture indeed. Real turnaround story, as you said. Now let's really look forward. How are they charting their future growth, especially with this bold Ambition 2030 plan and the apparent strength of their pipeline? What's the vision?
This is truly the crux of their forward-looking strategy and the core of the investment thesis, really. In May 2024, management unveiled Ambition 2030, which sets incredibly ambitious targets, $80 billion in total revenue by 2030.
$80 billion. That's a huge jump from the mid-50s now.
A huge jump. And launching at least 20 new medicines this decade, that speaks volumes about their deep conviction in their scientific capabilities and their pipeline. The strategy to get there is multifaceted. Sustaining leadership in oncology and biopharmaceuticals, building rare disease via election into a major contributor, and strategically entering new high-growth areas like weight management.
So they're looking at the GLP-1 space too.
They are exploring it, yes. And crucially, the plan involves aggressive investment in those transformative therapeutic modalities we touched on earlier. ADCs, radioconjugates, cell therapies, gene therapies, really the next frontier of medicine. They want to lead there.
$80 billion by 2030 is certainly audacious, and I understand they're making a huge specific play in the U.S. market to help achieve that, right? A big investment announcement.
Absolutely. A cornerstone of this Ambition 2030 strategy is a substantial commitment to the critically important U.S. market. AstraZeneca has pledged $50 billion for continued growth in the U.S.
$50 billion, just in the U.S.
Yes, including a new state-of-the-art manufacturing facility in Virginia. This significant investment serves multiple strategic purposes. It de-risks their global supply chain by localizing production of key medicines. It builds political goodwill in their largest and most profitable market, and it establishes domestic manufacturing capabilities for the complex biologics and potentially cell therapies central to their future pipeline. It ensures they can produce these cutting-edge medicines right where the demand is highest.
So it's a very smart strategic move. Addresses supply chain risk, political risk, and capability needs all at once. And all of this $80 billion ambition, hinges heavily on their R&D pipeline, correct? It sounds like they're pouring money into it.
Precisely. The credibility of Ambition 2030 rests almost entirely on their R&D engine delivering. AstraZeneca maintains one of the highest R&D investment rates in the entire industry. They spent $13.6 billion in 2024, which is over 25%, 25.1% of revenue.
Wow, a quarter of revenue back into R&D.
Yeah. They expect this rate to remain high, in the low 20% range long term. This isn't just spending money, it's a strategic investment in their future growth. As of mid-2025, their pipeline boasts an impressive 196 projects in development, with 19 new molecular entities in late-stage phase 3 development.
19 in late stage. That sounds productive.
Very. And they've demonstrated strong clinical momentum recently, with 12 positive key phase 3 trial readouts just in the first half of 2025 alone. Management estimates these readouts, if approved and successful commercially, have the potential to generate over $10 billion in peak annual revenue on a risk-adjusted basis. That's a massive potential return from their recent clinical work.
That's a huge potential return from just those recent trials. Can you highlight some of these critical late-stage assets, the ones that are absolutely key to achieving Ambition 2030 and maybe more immediately to navigating that significant patent cliff for Farxiga and others?
Yeah, absolutely. If we connect this to the bigger picture of navigating the patent cliff and actually reaching that $80 billion revenue target, these late-stage assets are absolutely crucial. Several stand out. First, Datoray, datopotamab deruxtecan. This is another TROP2-directed ADC partnered with Daiichi Sankyo.
Like Enhertu.
Similar technology platform, different target. TROP2 is a protein often found on the surface of various cancer cells, making it a promising target. Datoray has already been approved for certain types of breast and lung cancer and is expected to be a multi-billion-dollar product with significant expansion potential into other tumors. It's a huge part of the ADC leadership strategy.
Okay, Datoray is key. What else?
Then there's Camistrant. This is an oral SERD for hormone receptor-positive breast cancer.
An oral SRD. Break that down.
Sure. A SERD is a selective estrogen receptor degrader. It's a type of targeted therapy that works by breaking down the estrogen receptor protein within cancer cells. This receptor is crucial for the growth of hormone receptor-positive breast cancer, which is the most common type. Camistrant is positioned as a potential new standard of care taken as a pill in a very large patient population. High hopes for that one.
Interesting. And what about in the immuno-oncology space beyond Imfinzi? Are they developing next-generation approaches there?
Yes, they are. A key one is volrustomig. This is a PD-1 CTLA-4 bispecific antibody.
Bispecific, meaning it hits two targets.
Exactly. Think of a bispecific antibody like a molecule with two different arms, each designed to latch onto a different target. In this case, one arm targets PD-1 and the other targets CTLA-4. Both are important checkpoint proteins that cancer cells exploit to hide from the immune system. By hitting both simultaneously, volrustomig is designed to unleash an even stronger immune response against tumors like lung, cervical, and mesothelioma cancers. The hope is it could improve upon existing checkpoint inhibitors like Imfinzi or Keytruda.
Trying to improve on current standards. Makes sense. Any others worth highlighting?
Definitely. There's Serapirib, which is a next-generation PRP inhibitor, specifically targeting PRP1. It's designed for improved efficacy and potentially better safety compared to first-generation PRP inhibitors, like their own Lynparza. So innovating within a space they already lead. And then in different areas, you have Senesocitinib vedotin, another ADC targeting CLDN 18.2 for gastric cancer, and Baxdrostat, which is a potential first-in-class treatment for hypertension and chronic kidney disease, moving outside oncology there. Successfully launching these and others in that late-stage pipeline is not just about growth, it's about replacing potentially billions in lost revenue from the patent cliff and propelling them towards that 2030 ambition. The stakes are very high for these assets.
That's a very impressive lineup of potential blockbusters across diverse mechanisms and modalities. It's clear they're making big strategic bets. What role does M&A and external partnerships play beyond their internal R&D efforts to achieve these ambitious goals? Are they still actively acquiring?
They are. Beyond that massive internal R&D spend, AstraZeneca has a proven strategy of using science-led M&A to access external innovation and bolster their pipeline where needed. The $39 billion election acquisition in 2021 was obviously the big transformative move that instantly established their rare disease pillar, diversifying their revenue streams significantly.
Right, that changed the shape of the company.
It really did. More recently, though, they've done smaller, more technology-focused bolt-on acquisitions. Deals like buying Fusion Pharmaceuticals to get into radioconjugates, which are targeted radiation therapies.
Another guided missile type approach.
Sort of, yes, using radiation. And acquiring ESO Biotech for cell therapy capabilities, a deal that could be worth up to $1 billion depending on milestones. These deals aren't just about buying near-term revenue. They're about building capabilities in these next-generation modalities, positioning them for sustained growth well beyond 2030 by bringing in new scientific platforms and expertise.
So buying future growth platforms, not just current drugs.
Exactly. And they remain active in geographic expansion and digital initiatives, too. While the U.S. is clearly a major investment focus, those emerging markets remain key for volume growth. And digital and AI solutions are being deployed across the entire enterprise, R&D, manufacturing, commercial, to drive efficiencies and improve outcomes. It touches every part of their business now.
So a powerful combination of bold internal R&D, strategic acquisitions to bring in cutting-edge tech, and a clear geographic and digital focus. Okay, let's delve into how they manage their capital now and assess the inherent risks they face. What's their philosophy on capital allocation? How do they decide where the money goes, and how does that impact shareholder value?
AstraZeneca's board has a very clear, publicly stated, hierarchical set of priorities for capital deployment. This provides a strong framework for their financial decisions and signals their strategic intent.
Okay, what's the hierarchy? What comes first?
First and foremost is investing in the business and the pipeline for organic growth. That science-led approach we've been discussing is priority number one.
Reinvesting in themselves.
Exactly. Second is maintaining a strong investment-grade credit rating, which gives them financial stability and access to capital markets. Third is pursuing value-enhancing business development that means strategic M&A, like election or fusion, and licensing deals. And finally, fourth on the list is supporting a progressive dividend policy for shareholders.
So dividends are fourth. That's interesting.
It is. This framework clearly signals that reinvestment for future growth is their primary focus for long-term value creation. It underscores their commitment to building sustainable leadership through innovation before prioritizing immediate shareholder returns beyond a steady dividend.
That's a very clear prioritization, putting internal growth first. What does progressive dividend policy actually mean in practice for shareholders? Are they reliable payers?
A progressive dividend policy generally means the company aims to maintain or ideally grow the dividend amount each year. It signals management's strong confidence in future earnings and the stability of their business model.
And have they been doing that?
Yes. The total dividend for fiscal year 2024 was $3.10 per share, which represented a 7% increase from the previous year. And the H1 2025 interim dividend was $1.03 per share, a 3% increase. They paid dividends semi-annually. The dividend cover, that's earnings relative to the dividend payout, is approximately 1.3x, and the payout ratio is around 66% of earnings.
So they earn enough to cover it comfortably.
Yes, those metrics indicate the dividend is sustainable and has room for future growth, even with their ambitious investment plans. This commitment to a growing dividend, especially right now amidst the upcoming patent cliff, implies management has very strong conviction that their pipeline can generate sufficient excess cash flow to support both reinvestment and growing shareholder returns.
It's interesting that they prioritize dividends and reinvestment over large-scale share repurchases, which seems to be a much more common practice for many large U.S. companies. Is that a deliberate strategic choice?
Yes, it appears to be a very deliberate and somewhat contrasting strategic choice, particularly compared to U.S. pharma peers. Unlike many of them, AstraZeneca has not historically prioritized large-scale share repurchase programs. Their capital allocation framework, as we just discussed, strongly favors direct reinvestment in the business, funding R&D, building facilities, strategic M&A, and providing that growing dividend.
Why do you think they prefer that?
It reflects a deep-seated belief within management, particularly under Soriot, that deploying capital to drive future growth through scientific innovation will ultimately create significantly more long-term shareholder value than, say, financial engineering through buybacks simply to boost short-term EPS. It's a clear commitment to fundamental, science-driven growth over financial maneuvering.
Okay, so they're reinvesting heavily for the future. What are some of the most important recent developments and challenges they've faced, say, between 2023 and mid-2025, that really illustrate their current position and the pressures they're under?
Well, in terms of recent financial performance, Q2 2025 was actually a strong quarter for AstraZeneca, reinforcing their growth narrative despite the headwinds. They reported total revenue of $14.46 billion, which was up nearly 12%, 11.7% year over year, impressively beating analyst expectations.
Okay, strong top line.
And core EPS came in at $2.17, also significantly above the market consensus. Following that, management reiterated their full year 2025 guidance for high single-digit revenue growth and low double-digit core EPS growth. So that signals continued confidence in their operational momentum for the year.
That's very solid performance, especially given the broader market environment and the looming patent cliff. And what about their pipeline and new drug approvals? Any big wins recently that support that confidence and help address the cliff?
Yes, several crucial wins on that front, which are vital. Major recent achievement was the series of approvals for Datroway, that TRP2 ADC we mentioned. The FDA approved it for metastatic breast cancer in January 2025, and then for EGFR mutated non-small cell lung cancer in June 2025.
So, launching into big markets.
Exactly. These approvals mark the launch of a major new growth driver for their oncology franchise and a critical step forward in their whole ADC platform strategy. Additionally, another new cancer drug, Trucop, capivasertib, has seen robust initial sales of $302 million just in the first half of 2025. That demonstrates strong early commercial execution, which is key for new launches.
Good commercial start is crucial.
Absolutely. And they continue to deliver positive clinical data. Those 12 positive key phase 3 trial readouts in H1 2025 alone included promising results for baxdrostat in hypertension kidney disease and even a new indication for their existing blockbuster Tagrisso. These are all vital steps for filling that eventual revenue gap from expiring patents.
So, successful new launches and strong clinical progress, which sounds promising for tackling the patent cliff. But what about those patent expirations themselves? Keep circling back to Farxiga. Are there any updates on its situation? Is litigation ongoing?
Yes, the most pressing near-term challenge remains that impending loss of market exclusivity for Farxiga in 2025. AstraZeneca is actively engaged in litigation, trying to defend its intellectual property and perhaps delay generic entry, but this is a significant revenue stream undeniably at risk. The market is watching those legal developments very closely. And just to close the loop, as for their COVID-19 business, revenue from those products is now officially immaterial. They've fully transitioned back to focusing on their core therapeutic areas.
Okay, so Farxiga is the big, immediate cliff focus. Beyond patents, what about regulatory and legal challenges? You mentioned the IRA earlier. Has that had any direct, specific impact on AstraZeneca yet?
Yes, this raises the important question. How will regulatory pressure specifically impact them, not just the industry? And the answer is it already is. In May 2025, a U.S. federal appellate court rejected AstraZeneca's legal challenge to the Medicare drug price negotiation program under the Inflation Reduction Act.
So their lawsuit didn't succeed.
No. This court decision confirms that the IRA pricing pressures are a tangible, unavoidable headwind. It directly impacts key drugs like Farxiga, which was actually selected as one of the first drugs for Medicare negotiations. So that pricing pressure is a reality they must now manage and mitigate financially.
That's a significant confirmation of that risk.
It is. Furthermore, circling back to China, they are cooperating with ongoing investigations by Chinese authorities. The exact nature and potential impact are still unclear, but it represents a source of uncertainty and significant near-term risk in that crucial but increasingly complex market.
Okay, so a lot of moving parts, strong performance, pipeline progress, but very real patent, pricing, and geopolitical challenges. A true test of their strategy. Let's try to pull it all together now into a comprehensive risk assessment. What's the single biggest, most quantifiable threat to AstraZeneca's ambitious trajectory towards $80 billion?
The most significant and quantifiable risk is, without a shadow of a doubt, the patent cliff and the resulting biosimilar or generic competition. Farxiga, with that $7.7 billion in 2024 sales and its 2025 expiry, is the largest single product facing this immediate threat.
The 800-pound gorilla.
Exactly. Then there's Soliris, with $2.6 billion in sales and biosimilar competition starting in 2025. And Lynparza, with $3.7 billion in sales, set to lose exclusivity in 2027 in the US and 2028 in the EU. The combined revenue from just these three products represents a substantial portion of current sales. Their ability to launch and rapidly scale those new pipeline products we discussed is an absolute necessity to mitigate this and avoid a significant revenue gap opening up.
That's a huge chunk of revenue at risk, requiring massive innovation and commercial success just to stand still, let alone grow towards $80 billion. What other major risks are top of mind for a company with such ambitious goals?
Well, inherent in drug development itself are significant regulatory and clinical trial risks. Ambition 2030 relies heavily on the successful development and approval of many new medicines. A failure in a pivotal phase 3 trial for one of those high potential late stage assets we talked about, like chemistrant or volrustomig, or unexpected regulatory delays or even rejections, could seriously jeopardize their long term targets and severely impact the growth story the market has bought into.
Pipeline execution risk is huge.
Huge. Then there's the intensifying pricing, reimbursement, and market access risk globally. We saw the U.S. IRA leading to mandatory price reductions, confirmed now for Farxiga. Similar pressures exist in Europe, with things like health technology assessments demanding more evidence for value, and in China with that volume-based procurement driving down prices. It's a global phenomenon.
And given their strong presence in China, which we keep mentioning, is that a particularly acute risk factor right now compared to peers?
I would say yes. Their 13% revenue concentration in China, which is higher than some peers, coupled with those ongoing investigations by Chinese authorities, creates major uncertainty and necessitates careful monitoring. It's a specific vulnerability for them. Beyond that, you have broader geopolitical tensions potentially disrupting supply chains, for instance, for active pharmaceutical ingredients sourced from China or India. That requires ongoing focus on that right-shoring strategy we discussed.
Makes sense. Any other key risks?
Finally, I'd say execution and integration risk. Achieving Ambition 2030 requires near-flawless execution across R&D, manufacturing, and commercial operations. Commercial execution for all those new launches is absolutely vital to offset the patent cliff losses. And M&A integration, even with successful deals like Election, always carries risks of not realizing the expected synergies or smooth operational merging. It's a complex dance with very high stakes across the board.
That's a very balanced and thorough look at the risks, outlining precisely what they need to get right and what could go wrong. Okay, let's turn to valuation now. How does the market currently view AstraZeneca? Is it expensive, cheap, fairly valued? And what does that imply for potential investors trying to weigh all these factors, the growth, the pipeline, the risks?
What's really telling here is that AstraZeneca generally trades at a premium compared to many of its large-cap pharmaceutical peers. This isn't particularly surprising given its strong recent performance, the successful turnaround story, and the high market expectations for its future growth, particularly from that oncology pipeline.
So the market recognizes the growth story.
It does, and it's paying for it. As of August 2025, its price-to-earnings, or PE ratio, is approximately 30.2x on a trailing 12-month basis.
Okay, 30x PE. How does that compare historically for them?
Well, while 30x might seem high in isolation, it's actually significantly below its 10-year average, which was around 80x, and its 5-year average, around 124x. Those historical averages were heavily skewed upwards by periods of past earnings depression during its earlier challenges, making the PE look artificially high then. More reasonably, the current 30x is actually a discount compared to its 3-year average PE, which was closer to 42x. This suggests the valuation has perhaps rationalized somewhat as earnings have grown more consistently.
Okay, so it's premium relative to peers, but maybe not as high as it has been historically for AstraZeneca itself, reflecting more consistent earnings now. How did that 30x PE compare directly to its competitors today, and what does that premium actually imply?
Right. If we compare it directly to its peer group, AstraZeneca's PE of around 30x is definitely higher than companies like Pfizer, around 13.7x, Merck, around 13.4x, and Novartis, around 18.4x.
Quite a bit higher than those.
Yes. This directly indicates the market is willing to pay more for AstraZeneca's double-digit growth profile and its compelling pipeline story. Essentially, investors are placing a higher multiple on its expected future earnings potential compared to those peers with perhaps slower growth outlooks. However, it's considerably lower than Eli Lilly, which is trading at around 46.4x PE, currently benefiting from that explosive GLP-1 franchise growth.
Okay, so somewhere in the middle of the premium pack.
Sort of. And looking at another metric, enterprise value to EBITDA, AstraZeneca's multiple of around 13.8x is actually much closer to peers like Johnson & Johnson, also 13.8x, offering a slightly different perspective that suggests maybe it's not quite as expensive on that basis. But the key implication remains. The premium, particularly on PE, implies that significant future growth is already baked into the stock price by the market. This makes the company vulnerable to a sharp de-rating if it fails to meet these high expectations. Execution is absolutely key to justifying this valuation.
So the market expects a lot, and they need to deliver. But you mentioned earlier that some intrinsic valuation models, like discounted cash flow or DCF, tell a somewhat different story, possibly suggesting a potential undervaluation. What accounts for that discrepancy between the relative premium and potential intrinsic value?
This raises the really important question for an investor. What's the true underlying value here? While the relative multiples show a premium versus many peers, some discounted cash flow models, which try to estimate intrinsic value based on future cash flows, do suggest potential undervaluation. For example, one model I saw estimated a fair value of around $147 per share, compared to its current share price of about $81 per share.
That's a big difference, 147 versus $81.
It is. And this discrepancy between the relative valuation, which shows a premium on multiples, and the potential intrinsic valuation, suggesting undervaluation from DCF, highlights the investment case's core tension. The market may be pricing in the near-term growth, but potentially not fully appreciating the long-term cash flow generation potential if AstraZeneca truly achieves Ambition 2030 and successfully launches those pipeline assets.
So the DCF depends heavily on believing the long-term plan.
Absolutely. Key DCF drivers here are highly sensitive to assumptions about future revenue growth, how quickly new drugs ramp up, how badly patent expirations hit, the trajectory of operating margins, the discount rate used, the WACC, or weighted average cost of capital, which itself is influenced by factors like AZN's relatively low beta, suggesting lower market volatility, and of course a conservative terminal growth rate assumption. It really comes down to how confident an investor is in management's ability to execute that ambitious plan flawlessly over the next decade.
That's a fascinating tension for investors to grapple with a clear premium for near-term growth visible in multiples, but potentially more significant intrinsic value hidden in the long term if they deliver on the grand vision. Okay, let's wrap this up with a summary of the investment thesis. Distilling everything down, what are the absolutely critical factors that will dictate AstraZeneca's performance and shareholder returns over the next, say, 3 to 5 years?
I think the company's performance over the next 3 to 5 years will be dictated primarily by three dominant interconnected factors. First, sustaining their incredible oncology momentum. This means continued market share gains, successful label expansions for key drugs like Enhertu, Tagrisso, and Imfinzi, and crucially, strong commercial launches of those new assets like Datroway and Triquap. They need to keep firing on all cylinders in cancer.
Okay, oncology leadership is number one.
Second, flawlessly executing the pipeline transition. This means successfully navigating that patent cliff for Farxiga, Soliris, and Lynparza by ensuring those late-stage pipeline assets like Camistrant and Volrustomig launch successfully and scale rapidly. They absolutely must be ready to fill the revenue gap as it emerges.
Pipeline execution is number two.
And third, effectively managing those external headwinds. This involves mitigating the financial impact of the U.S. IRA pricing negotiations and deftly navigating the complex and sometimes unpredictable regulatory and political landscape in China. These are the key strategic battlegrounds where success or failure will be measured.
Makes sense. And looking beyond those immediate factors, how sustainable do you think this business model is in the long run, given all the industry pressures and their own ambitious goals? Can they keep this virtuous cycle going?
Based on their track record over the last decade and their current strategy, it appears highly sustainable. AstraZeneca's model is predicated on that virtuous cycle we discussed. Strong cash flows generated by its diversified portfolio fund, a high productivity R&D engine. This internal innovation is then strategically supplemented by disciplined, science-led M&A that allows the company to enter new therapeutic areas or acquire cutting-edge technologies when needed. This dual approach provides a robust and adaptable framework for creating long-term value and navigating the industry's inherent cyclicality and pricing pressures. It seems designed for endurance, assuming they keep executing.
What are the key catalysts, or conversely, the major risk events that investors should be keeping a very close eye on? The things that could significantly swing this thesis one way or the other?
Key positive catalysts to monitor would include positive Phase 3 data readouts for those critical late-stage assets like Camistrant or Volrustomig that would significantly de-risk future revenue projections. Also, better-than-expected commercial launches for new drugs like Datroway and Truqap, demonstrating strong market penetration capabilities. And potentially, further value accretive M&A that strengthens their platform technologies or pipeline.
Okay, those are the potential upsides. What about the key risks to watch?
On the flip side, key risk events that could derail the thesis include, most obviously, a major late-stage pipeline failure for one of those crucial assets. Also, adverse regulatory or legal outcomes, think harsher than expected IRA price cuts following negotiation, or significantly negative results from the ongoing China investigations. And of course, patent litigation losses that might accelerate in generic entry for key drugs like Farxiga or Lynparza, widening that patent cliff challenge.
Management's track record plays into this.
Immensely. Management's track record under CEO Pascal Soriot, who orchestrated that truly impressive turnaround since taking over in 2012, lends significant credibility to their ambitious targets, like Ambition 2030. Their history of generally meeting or exceeding guidance builds confidence. However, the positive investment thesis would clearly be invalidated by a series of major pipeline failures, severe unforeseen disruption in China, or significant commercial underperformance of key new launches, leading to an unbridgeable revenue gap that even their strong execution couldn't overcome.
So as we wrap up this deep dive, you've really painted a clear picture of how AstraZeneca has transformed itself. From facing a daunting patent cliff just years ago into becoming a genuine growth leader in the pharma industry. They've done it by meticulously balancing cutting-edge scientific innovation, strategic acquisitions like Election, and navigating some really significant global headwinds like pricing pressure and geopolitical risks. It's a complex picture, certainly, of a company with a very ambitious vision for the future, all fueled by a remarkable turnaround.
Indeed, it's a testament, I think, to the power of focused strategy, consistent execution, and real scientific prowess in what is undoubtedly a high-stakes, rapidly evolving global environment. Their journey over the last decade really offers a masterclass in adapting to disruption and rebuilding value.
Okay, so here's a final provocative thought for you to consider as we finish. Given AstraZeneca's explicit Ambition 2030 and its clear dual strategy, relying on both its powerful internal R&D engine and external M&A to secure future growth, consider this. What role will truly disruptive, perhaps completely unforeseen scientific breakthroughs emerging from smaller, more agile biotech companies play in the coming years? Could these external innovations either upend or perhaps even accelerate the carefully laid plans of a pharmaceutical giant like AstraZeneca? And what does that possibility tell us about where the next wave of truly paradigm-shifting innovation really originates in the complex world of medicine? It's a dynamic landscape out there, and the future is always being written, often it seems, in the most unexpected places.